Most of us believe we are above average. Let's ask a question. Do you believe that you're a good driver? Do you believe that you are above average? In repeated studies, 8 out of 10 men believe that they are above average drivers. This is clearly not possible. At least 3 of the 8 are mistaken. We regularly overestimate our abilities. We think fondly of our past successes and ignore or forget our past failures. We paint a picture of ourselves where we think we are at least slightly better than half of the population. We do the same with investing. We know it's an integral part of our financial life, and we want to do it well. We hope that we can do better than others. No one likes the idea of getting below average investment returns. We seek the best. In investing, there's a concept of the index. It is a collection of companies selected based on specific criteria, such as geography and size, not on past performance metrics. For example, the famous S&P 500 index comprises Standard & Poor's list of the 500 largest companies by capitalization. How exactly that is calculated is irrelevant. We'll let the nerds figure that out. There are mutual funds and exchange-traded funds that try to mirror the index. That is, they buy the stocks on the S&P's list of 500 companies in the precise weighting that they are on the list. For example, Vanguard's S&P 500 index ETF has Apple, Microsoft, and Amazon as its top 3 holdings, in the same weightings as the S&P 500. Vanguard doesn't try and buy and sell companies based on what it thinks those companies will do. It simply buys the companies in the index in the appropriate weights. This practice is called passive investing. You can find index funds that track all kinds of indexes. All they do is buy the companies on the list and sell them when they leave the list. Passive. Passive? Isn't passive bad? Shouldn't we be proactive? Shouldn't we try to do more than sit on our hands and let life happen to us? Here's my first point. Many people think indexing means you get average returns. The thinking goes that if these index funds are not trying to do anything other than match the index's returns, minus a tiny bit of fees, then applying any amount of skill should get you better returns than the market. Countless people try and beat those returns, both individuals and professionals. If you look at any fund's past performance, they will usually see it compared to what index it most closely resembles, even if it's not trying to track that index. The index will be known as the benchmark, and it is used as a reference point. And this is helpful because it allows you to see if the returns are due to the fund's strategy or just due to general market movement. Sure, this fund has averaged 7.8% over the last 10 years, but the index averaged 8.1%. So you know that the return wasn't due to the fund, but due to the market in general. There are thousands of investment professionals and fund managers and tens of thousands of DIY investors trying to beat these benchmarks. They see the indexes as quote-unquote average, and they're trying to beat them. They're trying to be above average. I want you to think about investing as the investor golf tournament. The tournament has 2 parts, the working half and the retired half. Each half is 36 holes for a total of 72 holes, and each hole represents 1 year of investing. The holes have different pars for each, but they are all between par 3 and par 5. You have either 3, 4, or 5 shots to try to get the ball from the tee into the hole to be par. In the investor golf tournament, the indexes are par. Some people are better than par. Professional golfers, even some serious recreational golfers, beat par all the time. But par is by no means average. Even though all golfers are trying to beat par, most do not. This quest to be above average by beating the indexes leads immediately to my next point. Point number 2, the vast majority of investors and professionals underperform the market. Let's look at each in turn. Investors. We saw in episode 1 that the average equity investor had received about half the percentage returns of the investments the investor invests in. If you have not listened to episode 1, you can find it at retirementorship.com/1. It is the essential episode for investing. Understanding the difference between investment returns and investor returns is critical. Over 30 years, ending 2019, the S&P 500 averaged 10%. The average equity investor averaged 5%. Over that amount of time, the average equity investor would have turned $100,000 into $450,000. The S&P 500 would have turned $100,000 into $2 million. Again, that's average. Some investors did better, some did worse. But you cannot possibly say that, based on that evidence, the S&P 500 represents quote-unquote average returns. They are literally, and when I say literally, I am using it correctly, literally double the return of the average investor. The index is not average. It is twice that of average. That ongoing study by Dalbar applies to all investors, both those in professionally managed funds and those doing their own investing. Let's look deeper at the DIYers. There's a famous white paper called Trading is Hazardous to Your Wealth. The authors studied households trading their selected stocks and trying to quote-unquote beat the market. Here is the abstract from the article. Individual investors who hold common stocks directly pay a tremendous performance penalty for active trading. Of the 66 households with accounts at a large discount broker over a 5-year period, those that traded the most earned an annual return of 11.4%, while the market returned 17.9%. The average household earned an annual return of 16.4% and turned over 75% of its portfolio annually. Overconfidence can explain high trading levels and the resulting poor performance of individual investors. Our central message is that trading is hazardous to your wealth. The paper is a little dated now, but the truth holds today, as evidenced by Dalbar's work and others. Investors trying to buy and sell their own stocks consistently underperform the market. This effect disproportionately affects men over women in a negative way. The authors did another study entitled Boys Will Be Boys, Gender, Overconfidence, and Common Stock Investment. The abstract? Theoretical models of financial markets built on the assumption that some investors are overconfident yield one central prediction. Overconfident investors will trade too much. We test this prediction by partitioning investors on the basis of a variable that provides a natural proxy for overconfidence: gender. Psychological research has established that men are more prone to overconfidence than women. Thus, models of investor overconfidence predict that men will trade more and perform worse than women. Using account data from over 35,000 households from a large discount brokerage firm, we analyzed the common stock investments of men and women over 6 years. Consistent with the predictions of the overconfidence models, we document that men trade 45% more than women and earn an annual risk-adjusted net returns that are 1.4% less than those earned by women. These differences are more pronounced between single men and single women. Single men trade 67% more than single women and earn an annual risk-adjusted net return that are 2.3% less than those earned by women. So not only will managing your own investments average you 36% lower returns than the so-called average index, single men are likely to receive 50% lower returns due to their own overconfidence. Bro, I hope you just heard that. Let me translate quote-unquote overconfidence. The belief that you are or can be better than others. The conclusions of these studies still ring true today. That's just the actual trading performance over 5 years. Then you throw in the behavioral mistakes that are covered in episode 4, the 4 horsemen, and you'll get even lower returns over a more extended period. When comparing the average investor to indexes over long periods, the index is decidedly not average. Professionals. So what about professionals? Most investors don't buy and sell individual stocks anyways. They entrust that to mutual fund managers and their 401ks and to their investment advisors and their IRAs. Surely those professionals with that skill and expertise can beat these quote-unquote average indexes. False. Professionals do perform better than average individual stock traders, but most of them do not beat the indexes after fees. Many studies support this phenomenon. Only 30 to 40% of active managers beat the index in any given year. According to Barron's, only 29% of active managers beat the benchmark in 2019, down from 37% in 2018. And of the active managers who did beat their market in 2018, only 12% beat their benchmark in 2019. So again, of the 37% who beat it in 1 year, only 12% went on to beat it the next. CNBC reported that 92% of professional investment managers underperform their relevant indexes over 15-year periods. Your immediate thought on hearing this may be, yes, but 8% of managers did beat the index over 15 years. Or, in the immortal words of Lloyd Christmas, so you're telling me there's a chance. The Index Fund Advisor reports the following. The S&P 500 index consistently outperformed 98% of mutual fund managers over the past 3 years and 97% over the past 10 years, ending October 2004. In two 30-year studies, the S&P 500 outperformed 97% and 94% of managers. In addition, only about 12% of the top 100 managers repeat their performance in the following years. Therefore, it is not possible to consistently pick next year's hot mutual fund manager. As Bethany McLean of Fortune put it, building a portfolio around index funds isn't settling for average, it's just refusing to believe in magic. To summarize, I'm not saying it's impossible to beat indexes. I am saying that most people don't, just as most people don't beat par in golf. You may shoot par or better on a hole or two, but as any golfer knows, a few bogeys will soon throw off your entire game. Let's reinforce this with a third point. Point number 3, people who have outperformed in the past are unlikely to do so in the future. Again, 12% of professionals who do outperform the index in a particular year underperform the following year. Most people can see that outperforming in one particular year doesn't mean that you will go on to outperform every year or even most years. If you get a birdie on a hole in golf, 1 under par, this does not mean that you will go on to birdie every hole or even that you will ever birdie again. What is more, 1 bogey will erase that birdie. You don't win a golf tournament by getting 1 birdie, and you don't get superior lifetime returns by outperforming in just 1 year. But there's a popular myth out there that people have developed to combat this 1-year performance issue. The myth goes like this. If you want to have above average returns, compare the long-term track record of funds and then pick the fund with the best long-term track record. Ignore the 1 or 3 year returns. Look at the 5 or 10 year returns or the since inception returns from the day that the company started the fund. By selecting funds with superior 10-year or since inception track records, you will likely continue to see superior future performance. 2 things right away. 1. Never compare funds based on their since inception returns. Since the funds are starting at different times, the returns will be wildly different. A fund that started in March of 2009, the bottom of the financial crisis, and has gone nowhere but up, will have a way better since inception return than a fund that started in September of 2007, at the previous peak. Their performance since 2009 might be identical, but their since inception returns will be worlds apart. Never compare funds based on their since inception returns. Number 2, 5 and 10-year returns are not long-term. Certainly not 5 years, and I want to challenge you on 10 years. The average investor will be working and investing for 40 years and will be retired and investing for 30 more. When you are thinking about long-term returns, you should be thinking decades, not years. Beyond that, long-term returns might not be due to continued discipline and strategy. It might just be due to luck. Suppose you are chatting with a fellow golfer in the investor golf tournament, and he reveals that he is 4 under par after just 10 holes. You think at first, wow, this is a good golfer. He must be consistently getting pars and birdies. At this rate, after 72 holes, he's going to be 28 under par. But then you find out 2 things. 1. In his first hole, a par 5, his drive was hard and far, but he sliced it, shooting it off to the right and missing the fairway. The ball bounced off a cart path and hit a groundkeeper's mower that blasted it back towards the hole. It bounced off a tree and dribbled straight into the hole. A hole-in-one on a par 5. Thus, the 4 under. He's been hitting par ever since. 2. He retried his drive from the tee box 10 times. He kept taking mulligans for his bad drives until he hit the lucky shot. That was the one he decided to play. Now how do you feel about him? He certainly isn't the world-class golfer you thought he was. He's gotten several pars, yes, but his edge was by luck and cheating. This is how many mutual funds operate. You can compare the quote-unquote long-term 10-year track records of funds, and you can see that one fund has a better 10-year average than the other. This observation may lead you to believe that the first fund has been consistently outperforming the other, leading to the gap in returns. But this may not be true. When mutual fund companies create mutual funds, they often create several at the same time. Perhaps they start 10 new funds with slightly different strategies. They each buy slightly different combinations of companies. They are all private at first, not in the general market. 5 of the funds outperform the indexes, and 5 of the funds underperform. They close the funds that underperform and release the remaining 5 to the public. In the first year, 1 of the 5 seriously outperforms and the other 4 underperform. No one wants to invest in a new fund already underperforming, so they close the 4 and keep the 1. Going forward, that last fund of the original 10 only needs to make quote-unquote average returns by generally tracking the index. But because it got lucky in the first year, it will now have a 5, 10, and since inception track record of being better than the index, and they can charge a higher fee for that initial luck. It happens all the time. A fund's outperformance isn't due to superior strategy or disciplines. It may only be superior because of luck. The company, quote-unquote, took a mulligan on the other 9 funds it developed to keep the one that had a good fortune to buy Amazon before it took off. Investment advisors are no better. Thankfully, most good financial planners and investment advisors don't try to compete on performance, but some still do. Their so-called outperformance may be due to the same phenomenon as mutual fund managers. They got one good call, and they've been riding it ever since. There used to be a practice with stockbrokers many moons ago, which I'm pretty sure has been made illegal, and I don't think anyone does it now. A stockbroker would call 128 random people after the market closed and leave a message if no one answered. Hello, I am stockbroker with XYZ firm. I know you have no reason to trust me or invest with me yet, but I'm going to prove to you that I can predict the stock market and get you above average returns. I predict that tomorrow the market will go up. I'll call you back tomorrow and predict the next day. Have a great day. Half the calls, he would predict that the market would go up. Half the calls, he would predict that it would go down. The next day, the market would do one or the other, as it always does. If the market was up as it closed, the broker would only call the 64 people he had predicted that it would go up and forget about the other 64. Hello, I am stockbroker with XYZ Brokerage. As I predicted, the stock market went up. But you may be thinking, big whoop, anyone can be right once. To prove that I'm the real deal, I'm going to predict it again. Tomorrow, it will go down. I'll call you tomorrow. Have a great day. Half the calls, he would predict the market would go down, the other half, that it would go up. The next day, the market would go up or down, as it always does. He'd call the 32 investors that he predicted correctly and forget about the others. They'd probably forget about him too. You see where this is going. After 5 days, he would be down to 4 investors, cutting 128.5 5 times by pure luck. Hello, I am stockbroker with XYZ Brokerage. I've predicted the stock market 5 days in a row now, and have been right every time. Are you ready to invest with me? He demonstrated superior returns, purely from luck in the game of numbers. To my knowledge, no one does this anymore, but I contend that those who point back at their track record and point to their being superior because of their insights and expertise alone are also misguided and may be misleading. Let's say you run into that golfer again on hole 12. You find out that he's no longer 4 below par, he is now 5 over. Because he is in the middle of the tournament, he can no longer get away with mulligans. His first drive went into the water hazard. He sliced his second out of bounds. His third was playable but not on the fairway. He tried to split 2 trees and hit one of them, bouncing the ball back further away. Anyone who's ever golfed has experienced this scenario. You are playing well the entire round, and then you have that hole where everything goes wrong, and you get it in 9 strokes. Track record, ruined. Those who have previously outperformed, both in golf and investing, are not guaranteed to outperform in the future. There is no evidence for the persistence of performance. I'm not saying that there's no way to identify winning strategies that will beat par or an index in the future. I'm simply saying that you cannot identify that strategy from past performance. This conclusion is why, in episode 5 questions to ask your financial advisor, I said that asking about past performance is a dumb question. Past performance is no guarantee of future results. Many people believe that an index represents average returns. In fact, indexes double the average investor's return over 30 years and outperforms 92 to 98% of all professionals over long periods. And the few who have outperformed in the past are unlikely to do so in the future. What shall we say then? Just buy an S&P 500 index fund and do nothing else? In theory, this means you would double the average investor's return over 30 years and be seriously above average. However, this assumes that you never fall to chasing returns, poor diversification, euphoria, or panic over 3 to 6 decades. Evidence shows that most people cannot do this. Not without pillars 1 and 2 from last week, built on pillars 3 through 5. I reject the common thought that everyone should merely buy an index fund because of its low fees and good performance. It ignores behavior, which makes up the majority of a person's lifetime returns. And I've encountered people who, in their quest for low fees, have chosen index funds with truly terrible long-term returns. There's more to it than merely going passive. You need the 7 pillars that we covered last week. If you have all 7 pillars and practice them faithfully, you will be above average. Let's examine the last point. Point number 4, it is possible to beat par. I'm not a good golfer. I perform pretty poorly on the first 9 holes, par 36, and usually worse on holes 10 through 18, par 72 total. Someone in my office is a good golfer, and he heard once that I was going golfing over a weekend. On Monday he asked, "So you went golfing, how'd it go?" I said, pretty good. I got a score of 80. 80, he exclaims. That's really good. Well, yes, I admit, but I only golfed 9 holes. That's the kind of golfer I am. In investing in golf, you are not directly competing against anyone, but you can see how you line up against everyone. So let's assume that I need to play for this investor golf tournament. My whole financial life is depending on my performance in this tournament. Luckily, I don't have to win. I need to play reasonably well across 72 holes, par 288. I need to try to get under 300 strokes and no worse than 400 strokes. That's a lot of golf. Again, my lousy performance get worse after just 9 holes. Whoopee, only 61 more to go. If the stakes were that high, then my family's whole financial future depended on my personal performance in this epic tournament, I'd probably find a coach. Suppose I was approached by a coach who proposed the following. I can teach you how to make par. I can tell you this for sure. My strategy takes enormous discipline and patience. And I can promise that you will never get an eagle on any hole, never get 2 under par. And we can be reasonably certain that you will probably never get any birdies either, although you might. What I can tell you is that, using my plan, working with my coaching, and applying the discipline and patience, you will get at least par on every hole. I'd hire that coach. I wouldn't care about getting birdies and eagles. I wouldn't care about getting the longest drive or making the putt that was furthest from the hole. To ensure my family's financial future would be set, I would only need to get less than 300 strokes. I don't care about how many strokes I'm over or under at hole 10, 30, or 50. It only matters what my score is on hole 72. And if I can be assured that I would get par on every hole, that would result in a score of 288, less than the 300 I need, even if it meant never getting any eagles and never getting any birdies, I would take that deal in a heartbeat. If you have ever golfed and know how bad you are, I'm sure you'd take that deal too. Here's a problem. We have celebrity investors out there who do consistently beat the S&P 500 or other indexes. We hear things like, you should invest like Warren Buffett, or this is how fund manager Peter Lynch beat the market for decades and how you can too. But I'm not Warren Buffett or Peter Lynch, any more than I'm Tiger Woods or Rory McIlroy. These golfers probably would not take a guaranteed par deal. They can beat par over 72 holes, by a lot. Par doesn't interest them. Birdies and eagles do. But I'm not them, and neither are you. So invest on principles and disciplines, yes, but realize that just because some billionaire buys a bunch of Bitcoin doesn't mean you should. We set out to answer how to be above average. Here it is, concisely. If you want to be above average, this means beating the average investor. To do that, you need to do two things. Number one, adopt and practice for 3 to 6 decades the 7 pillars of victory. Number two, avoid and destroy for 3 to 6 decades the 4 horsemen. Then you will be above average. If you want to beat par, as opposed to beating average, you must first recognize that these are different things. Beating par is somewhat trickier, but it is still possible. You need 3 things to beat par over a lifetime. 1. Never fall too far behind. If you score a 10 or 11 on a par 4 at any point in a golf tournament, it's pretty hard to come back from that. Again, no one should care what your score is on hole 10, as long as you aren't too far behind. It only matters what it is on hole 72. But coming back from 8 over is tough. It's also tough coming back from a huge loss that was only suffered by you and not the index, or missing out on a huge gain that the index did get. Never fall too far behind. Number 2, don't own any categories that have always underperformed. I'm not saying you shouldn't own a fund that has underperformed the S&P 500 over the last 3 years. I'm saying don't own any asset classes that have always underperformed. Your total portfolio won't outperform the S&P 500, won't beat par over 30 to 60 years if 10 to 40% of it is in bonds. Not possible. Even if your equities outperform, your portfolio won't. It doesn't help you to get excellent scores on all par 3 and par 5 holes if you bogey every par 4 hole. It doesn't matter if half your portfolio is slightly overperforming if the other half is performing half as well. Don't own any categories that have always underperformed. And number 3, invest in multiple equity categories that have historically outperformed at times. Not funds that have outperformed the S&P 500 always. You can't find those. Instead, categories of equities that have outperformed at times. It is doubtful you will beat the S&P 500 by owning a fund that actively trades in the same 500 companies. You must add in funds that are in other categories spread across large, medium, and small caps, value and growth, and the like. Owning these must be part of a plan with a partner that you understand, believe, and act on with patience and discipline. These statements are not investment advice. I'm not telling you to do this, nor am I saying that you even should. But you asked how to beat par, and that is how you would go about trying. Creating a plan involving 100% equities spread across multiple categories, perfectly working with all 7 pillars for 30 to 60 years. Simple, not easy. If it's intriguing to you, find yourself an advisor or planner who understands this and can help you build and follow such a plan. The averages say that you won't do so otherwise. You can beat average. It's even possible to beat par. First, you must understand that those are as different as investor returns and investment returns. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits, all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time.
We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, or you can click on the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.